Greetings, everybody. Thank you for joining us for our 2026 forecast webinar. We have many great insights to share with you. I've invited several of the leaders here at HVS to join me in the conversation. And I think, or I know, you are going to really enjoy hearing from them. Please use the Q&A feature of Zoom to leave us any questions that you might have during the presentation, or via email if you are watching this after the live recording. We'll be sharing the email addresses of our presenters towards the end of the presentation, or you're welcome to email me at rclough, rclough at hvs.com. And I'll make sure to get it to the right person or answer it myself for you. And we'll get back to you post-webinar. All right, lots to cover today. I want to go ahead and get started. First off, I want to show you our latest forecast of occupancy for the US. All right, perfect. And here we are. We are expecting occupancy to go up. We're going to do a little bit of a deeper dive on as to why, but we're showing about a half-point increase in occupancy this year, moving up to 62.7, before we get into some even more positive territory in 2027 and 2028. And ADR-wise, also in positive territory, not by much, just 1.5% this year, moving up to $163 before we get into some more substantial growth in the following years. Now to dive into these changes, the factors driving these changes, I've invited Katie Black and Ann Lloyd Jones to the webinar, two of our most esteemed and talented leaders here at HVS, if I don't say so. Thank you for joining me. Katie, I'm going to go ahead and start with you. If you could set the stage for us, how did we get here? What are your key takeaways from 2025?
Sure. Thanks, Rod, for having us. And hello, everyone. So to get started for this conversation for our 2026 forecast, it's really important that we understand what happened in 2025. So let's cover that real quick. Q1 was good. Hurricane-related demand and the inauguration kept occupancy flat, and rate was up 2% through March of 2025. If only the whole year could have continued this way. So Q2 came with government spending cutbacks, tariff announcements, and that overall resulted in decreased confidence and increased geopolitical tensions. This continued through Q3, and we started to see a noticeable cutback in inbound international travel that quarter, and rate growth completely stalled. Q4, we had the government shutdown with October and November producing the largest occupancy declines throughout the whole year in 2025. So when we blend all of this together, demand overall declined, with occupancy ending the year about 1 point below the 2024 level. Rate growth was sluggish and uneven, with the first 2 quarters driving nearly all of the rate growth for the year. The upper upscale and luxury segments by far led the way on rate growth, with all of their segments having rate declines in 2025. So performance was very market and asset class specific, and that's important and expected to continue going forward. So now that we know where we've been, which we all lived it, let's dive into 2026. Excuse me, 2026. I'm going to pass it on to Anne, and she's going to start this 2026 discussion with our expectations for supply changes going forward.
Good afternoon, everybody. It's nice to, I guess, not see you, but be seen by you. Wanted to talk about supply because, as we all know, occupancy is a result of trends in demand and trends in supply. If you look back over time, supply is very cyclical, very responsive, less so to demand and more so to the availability of financing and the cost of construction. If you go back 2 decades, the average supply increase was 1% on a compound basis. But really, that consists of a period of less than 1% growth, usually 4 or 5 years, and then a period of more than 1% growth. That's where the cyclicality comes in. At this point, we are coming out of 3 years with sub 1% growth. It's been increasing slightly, but it's still sub 1%, and we expect it to stay sub 1% through the next 2 years, driven by concerns with cost of construction, concerns with the availability of financing, and to a lesser extent, but meaningful, is the fact that there are not currently huge initiatives to develop different brands. We're seeing a lot of redevelopment. We are seeing things change brands, but compared to the 80s and 90s, the breadth of new construction is based on brand expansion is much less than it was. And that's probably going to be the situation for a while. So our expectation is, as I said, less than 1% growth for the next couple of years, and then more than 1% growth after that. And that cyclically, hopefully, will align, and we believe it will, with how demand trends. But Katie, why don't you talk a little bit about our perspective on demand?
Sure, absolutely. So there should definitely be some confidence on the demand side going into 2026 as economists and consumers shift away from some of that 2025 negativity. I think growth will likely start closer to Q2, with Q1 maybe seeing some normalization from the lack of that hurricane-related demand or inauguration-related demand from Q1 of 2025. Then moving on to Q2 and Q3, we have the World Cup, which is mid-June to mid-July, which is being hosted by 11 different US cities. So that should be a significant demand driver throughout the US. And a large part of that demand that's coming for the World Cup is international. And so with this strong international pull for the World Cup, it's expected, and hopefully, that this demand will start to move the needle towards increased international demand and improved confidence for foreign travelers coming here going forward. So hoping that not only will that one event be a good demand driver, but then also improve expectations for future inbound international travel. Moving on to the fourth quarter, without the government shutdown, I think the fourth quarter of 2026 will be where we see a lot of the demand growth year over year from 2025 to 2026. So the expectation is that we will hopefully have improved consumer confidence, less instability, less noise, less chaos from what happened in 2025, which should hopefully support increased travel overall. We're also hoping that players who may have sat on the sidelines in 2025 for groups or events will actually, rebook their event for 2026. So hopefully some of that group travel that was down in 2025 will be back this year. So 2026, it is expected that demand growth will outpace supply growth. Many of these factors that impacted demand in 2025, those won't necessarily go away, but the expectation is that they will impact the lodging industry to a lesser degree in 2026 as consumers acclimate sort of to the chaos and environment that we're in. So with that being said, occupancy growth is expected, relatively modest. But I think one of the more important conversations that's impacting the overall RevPAR growth for 2026 is rate. So I'm going to pass it back to Anne, and she's going to talk a little bit about ADR levels.
Thanks, Katie. So average rate is a product of the levels of demand and at any individual property, the yield management techniques that are being employed. And that rolled all together comes up to what the nation as a whole will experience or is expected to experience. And the problem going forward, and indeed some of the problems in the last year, has been that demand has been soft enough that people haven't been able to really drive rate. And we think that condition will continue into 2026 because the demand is starting to resume, but there's not going to be enough confidence to be aggressive with rate growth. People are still going to approach the equation with some caution. The good news, and Katie mentioned this, is the World Cup events. 11 different cities. They're 11 of the largest cities, and the impact will undoubtedly be primarily on average rate, and it will be significant. And we've gone back and done studies on how events such as a Super Bowl or a major hurricane or something like that affects the market, even inauguration, and they cause a big upward trend in ADR for the times that they're occurring. And that is going to affect the country as a whole, even if nobody goes anywhere other than those 11 cities. Those 11 cities and that demand are large enough that it will move the needle of the average ADR for the country as a whole. In terms of the rest of the country and the non-FIFA markets, World Cup markets, we think there will still be some softness and some caution that as occupancy and demand levels improve in subsequent years will drive ADR growth and thus RevPAR growth, because we're anticipating occupancy increasing as well. Wrapping up, I think what we've been talking about is the national forecast. And remember that that is an average of different markets in the country, all the different states, all the different product tiers. And what any national forecast shows is what the average of all of those. Individual properties, individual markets, based on their location, their profile, will have a different experience. And so we urge you not to just take these numbers and apply them to your hotel, but consider also the local factors and the specific individual factors in looking forward.
Right.
Rod, I think that's all we wanted to say.
All right, that's fantastic. I have a couple of slides, just a bit of a recap. Often many of you will just get the PDF of the deck and not get to hear these wonderful words and voices and insights from Katie and Ann. So just a recap of some of the factors that are driving, first, the positivity across the US. Despite the headlines, underneath the headlines, there's a lot of goodness happening out there when it comes to hotel demand. And it's particularly, as stated, prior year comparisons. So comparing what happened in 2025 to 2024 for obvious reasons, as Katie covered, things were a little bit more bleak. But now going into 2026, these factors, among others spoken today, will be driving, hopefully, a movement of that needle in the right direction. And then some yellow lights that we're still watching, because it's not all good news out there, as we know. And so we're monitoring some of the yellow lights out there as well. All right. Thank you to you both again. I appreciate you being here today. We'll be sharing their contact information at the end of the webinar, so you can reach out to either Katie or Ann if you'd like. They'd love to hear from you. Now we're going to turn beyond our borders and wanted you to hear from a couple of perspectives from outside the US. As international travel is so important to our industry and certainly a hot button today. So I welcome Fernanda. She's our leader in South America, and Carrie, one of our leaders senior leaders in Canada, to the call. Carrie, we are going to start with you. If you wouldn't mind, we would love to hear some stats from you regarding what's happened with inbound Canadian travel to the US. That's certainly a question that was brought up by many of our viewers today. Expectations going forward, and how your country is faring performance-wise. A lot of folks want to know about that too. So welcome from Vancouver.
Yeah, thank you. It's good to be here. I hope good to be here virtually. I hope you guys miss us in physical form, because to sort of set the context, travel patterns between Canada and the US have shifted meaningfully in 2025. Canadian trips to the US declined substantially year over year, with land travel, which is about 3/4 of all visitation between Canada and the US, down 30%. So through October, that represents about 8.5 million visits between Canada and the US. If we look at the next slide, what's important here is not just the magnitude of the decline, but the consistency. This wasn't necessarily a short-term dip. It seems to reflect a sustained pullback in cross-border travel behavior that was fairly consistent throughout 2025. You can start to see in the chart in February when tariff talks amped up, Canadian travel to the US started to fall off, and in May and September it was off as much as 31%. In terms of Canadian sentiment, it's ranged from anxiety about Canada's economic future in this environment, or what even it might be like crossing the border. Is there risk crossing the border? Or should people fear the experience of crossing the border? To the other end of the spectrum of kind of anger around the future of the relationship between the two countries. So, ultimately, this has manifested itself in a strong sense of national pride and patriotism, which has resulted in a real buy Canadian sentiment. And what's interesting is that this is not necessarily a one-off. We were sort of curious in the early parts of the year if the disenfranchisement that the Canadians had seen in February, March, or April would translate into a quick turnaround, and they would be willing to start coming back and traveling into the US the latter parts of the year. And we're not seeing that. It's been fairly sustained. So the portion of Canadian travel that's not coming to the US doesn't seem to be coming back, even as we start to get into the colder months of the year and the snowbirds likely want to head somewhere south. They're starting to favor other international destinations, and I think Mexico is being one of the key beneficiaries to that winter pickup. So if we look at the Canadian market as a whole, the domestic travel sentiment actually provided a bit of a cushion to the market. So with fewer Canadians traveling to the US, more demand stayed within the country and supported occupancy levels across many markets, which we really saw as a much more pronounced trend in Q3. So as the summer season hit and economic uncertainty stabilized a bit up here in Canada, people were ready to take their vacations and willing to take their vacations, spend some money, but they were doing that within Canada. So we're at 66% occupancy last year. That's a relative peak for the seasonality of our national market. And our outlook is that it'll stay there as we do have a growing supply pipeline. So much like what Katie and I were speaking about in the US market, the future growth is really going to be driven more by average room rate. So we're currently at historical levels for ADR and occupancy, and likely to set another record in 2026 as both Vancouver and Toronto will host FIFA games. So the key takeaway is this: in 2025, Canada benefited from strong domestic travel. RevPAR is at peak levels, with modest growth expected to continue to be driven by ADR gains in the foreseeable future. And it's expected that a portion of Canadians will continue to defer trips to the US in favor of domestic destinations or other international options. But that's likely to be at a similar pace that we saw through 2025. So we don't expect the situation to get worse in terms of Canadians not wanting to travel into the US, but there's not a clear path to recovery and some of that demand in the near term.
Okay, that's unfortunate.
We love
you guys.
We love it down there. We're just
yeah. Someday, right?
Yeah.
Someday.
Oh, for sure.
Yes. Okay, Carrie, thank you. I will be connecting Carrie with many of you that ask further questions about the Canadian market. I know there are many of you that are out there interested in what's happening in that ever-changing dynamic. So that's super helpful, Carrie. I'm going to now turn the mic over to Fernanda. You lead our practice in South America. I wanted to get a perspective from south of the border as well, and some of the US-related trends that you're seeing. So talk to us about what you're seeing from Argentina.
Okay, thank you, Rod. Thank you for the introduction. Good afternoon, everybody. It is a pleasure to be participating in this webinar. And with regards to South American tourism to the US, in contrast to Canadian trends, visitor arrivals remained flat in 2025. The region accounted for approximately 7.5% of total US visitors. The top source markets were Brazil, Argentina, and Colombia. Most of the countries exceeded the performance of 2019, Argentina and Brazil are still below but growing, especially Argentina that experienced a significant growth in the last 2 years. Colombia also exceeding 2019 levels and had a strong momentum in the last 4 years. The key drivers behind the region's positive outlook include an expanding middle class in Brazil and Colombia, and sustained demand for upper income groups in other South American countries, and also an improvement in air connectivity. Commercial demand is also fueled by the strong ties between the US and South American countries. The most visited destinations were Florida, New York, and California, especially because of the attractions related to the beaches, theme parks, cultural attractions, nightlife, and other offerings, entertainment offerings. Nevada and Texas, particularly cities like Miami, New York, and LA. Nevada and Houston were also ranked highly, with Las Vegas being an important destinations due to the entertainment options, and Houston business ties to South America. And looking ahead, we forecast a positive outlook for the region because for the South American visitation to the US, due to the improvement conditions in most of the South American economies, and also a sustained and demand for middle and upper income classes, and the improvement in air connectivity. One very important factor for affecting the demand to the US this year will be the FIFA World Cup, as most of the countries in the region are passionate soccer followers and are used to attending this event. However, even though the outlook is positive, some challenges persist and could hinder the outlook for the region, and are mostly related to the political instability of vulnerabilities in some countries, like currency devaluations, and also related to the high US costs.
Yeah.
And I think that's it.
All right, fantastic. Well, great to see your face. Thank you for
Okay, you
joining us
too.
today.
Okay.
Those of you that ask questions of that region, we'll make sure to connect you with Fernanda. Many of you asked questions specifically about Mexico. We're not touching on Mexico necessarily during this presentation, but I'll connect you with Richard Katzman for sure. Richard is hosting his Mexique conference here coming up in a few weeks, and it's a fantastic day-long event in Mexico City. If any of you are interested in investing in that part of the world, in Latin America or Mexico in particular, I really encourage you to attend Mexique. It's hosted at a fantastic hotel in Mexico City, and if those of you that have not been to the city, it's such a wonderful place to visit. So, and Fernanda, I imagine you will be there at Mexique?
Yeah, I will be there. Yes.
Great. So you can meet Fernanda.
Okay.
All right, perfect. Thank you.
Thank you. Bye-bye.
Thank you so much. All right, thanks for both of those perspectives. Now we're going to look at transactions. Never a dull moment in the transactions industry and trades and whatnot, although the numbers do appear a little bit dull. But anyway, here we have our graph of transaction activity in the US, and you'll see that things have still yet to take off. When I did my broker survey earlier in 2025, I think we all thought the fourth quarter would be a little bit more active than it was, but alas, it was not. So we're kicking that can down the road. We'll be talking to a couple of folks on my brokerage team here in a minute, and they're going to talk to us about why and what's happening, and when are we perhaps going to get into some more active phase of transactions. But this is where we ended the year in 2025, transaction-wise. And here you can see our cap rate data, the latest average cap rates for US limited service hotels versus full service. Limited service is coming in at about 8.5, full service is at about 8. Those of us that live and breathe cap rates, we know that these averages are truly an average of cap rates, going in cap rates that can be wildly off of an 8 or an 8.5 for whatever good reason. So just keep that in mind. there are good reasons for that to happen. But on a stabilized or deflated stabilized basis, an 8 to that 8.5 is where we're at right now. Very steady, very steady. We might start to see some of those averages decline, particularly on the full service side, once we start seeing some more cash challenged assets selling with more of a turnaround story ahead. They'll certainly sell for low going in cap rates if profitability is challenged there. And on the flip side, limited service hotels, normally we would think that we would see those cap rates closer to 9 or 9.5, but we are still seeing it at that lower level because the assets that are trading right now are those assets that are a little bit more popular, the extended stay hotels, the newer builds that might not have a big PIP investment upcoming. And with those and more kind of stronger in-place cash flow, you're able to kind of drive a little bit more bidding activity, get a little bit of a better price, and they tend to then trade maybe down closer to that 8.5 instead of that 9 or 10 that we might normally see. So that's where we are cap rate wise. Looking at discount rates, you can see that we are at a range of 9.5 to 11. There are certainly reasons why a hotel might trade with a discount rate underneath that range or above that range. But in general, 9.5 to 11, what's driving where the hotel kind of fits in that range is typically based on what property type it is. With the luxury, kind of harder to replace assets are trading closer using discount rates that are on the low end of the range, whereas the limited service hotels will certainly be closer to the high end of the range. The same goes for exit cap rates. We're looking at 7.5 to 9.5. There may be some good reason for you to use an exit cap that's slightly under that range or over that range, but for the most part, we're in that 7.5 to 9.5 range on exit cap rates right now. And we talked about the kind of stabilized cap rate range earlier during the presentation. All right, so that's where we're at right now. We are perhaps looking at a couple of more interest rate adjustments in 2026, knock on wood, with some more positivity in RevPAR growth. If we can get that under our belts, we might start to see some of these metrics just slightly decline and become more favorable in 2026. So we'll be monitoring that closely. But to get into this a little bit more, I am going to invite Eric and Matt, come on board, join me. Let's talk transactions and what you're seeing in your part of the world right now. So first off, Matt, I'm going to start with you.
Sure.
If you could talk to us about macro trends, what is going to be shaping hotel investment sales this year? What are you seeing from your desk?
Yeah, no, appreciate it, Rob. So there's a couple of things that we're kind of keeping eyes on this year. First and foremost would be seller motivation. We think owners kind of bring in deals to market that may have some debt maturity going on, or maybe there's like a CapEx event. They got to do a PIP or a 7-year refresh or something like that. Any of those that would require more input on the capital side, rather than throwing, good money after bad, maybe they decide to take it to market instead. Also strategic repositioning, and by that, I mean, if there's maybe a non-core asset in the portfolio, as owners look to kind of trim some of the fat, become a little bit more streamlined, maybe there's a deal in the portfolio that doesn't fit because of location. Maybe it's too far away for them to operate efficiently. Maybe the key count doesn't fit with what their portfolio goals are anymore, or maybe it's branding. Any of those options, we feel like will kind of influence decisions to bring a deal to market or not. Similarly, we're looking at capital stack and capital flow. As everybody knows, it's been kind of a challenge the last couple of years in the debt markets. So, we're seeing some return with lenders coming back to hospitality, but it's still very selective. There just has to be a pretty clear cut path to cash flow, or maybe a unique narrative surrounding the deal. And by that, I mean, if it's like a prime location with a top tier brand, but it needs a refresh in order to bring it back to the forefront of its comp set. Things like that, if there's some real tangible narrative that can merit DSCR coverage, all of these things will influence if a lender decides to participate or not. And similarly, it influences buyer confidence. And we're definitely keeping an eye on that. I think, over the last couple of years, buyers have been very cautious. Nobody wants to catch a falling knife, right? So I think what we're seeing as underwriting assumptions begin to stabilize, and it's going to kind of, like what we were talking about before with some of these tailwinds, see a little bit more investor confidence coming back to the market as, again, their assumptions start to normalize. And lastly, I think we've seen this bid-ask gap that's been pretty wide over the last couple of years, but there seems to be this acceptance in where the basis is kind of reset to. I think there's this general acknowledgement that we're not really going to see the pre-2022 valuations return, at least not in the short term. So it should help to accelerate deal flow as both buyers and sellers kind of align expectations with where current market conditions are.
Okay, so I'm just going to recap for just a second.
Sure.
If there's no real reason to sell right now, that kind of transaction activity is probably going to stay on the sidelines. Like there's got to be something to motivate the deal.
Compelling.
Okay.
Yeah, exactly.
Okay, great. Okay, Eric, today's cap markets, how's that influencing pricing expectations and that bid-ask spread that Matt just mentioned?
Yeah, so I'd say on the debt side, we're in a relatively liquid market. All the major capital sources are actively lending. We've seen the regional and local banks get back into the market too. And I think the big theme is that rates have meaningfully fell compared to maybe 18 months ago. So that sparked a lot of refinance activity, some potential sales. And I think for the rate stabilized cash flowing assets, we're seeing conventional loans priced in the, let's say, low sixes. 5-year CMBS paper is going to be in the high sixes, low sevens, and SBA products pricing right now in the sevens. So it's definitely gotten better than where it used to be. Although I will say that the drop in rates itself has not been able to bridge the gap between the buyer and seller. I think there still has to be some effort on the seller side to really bridge the gap on pricing. As far as the lenders go, as Matt said, they're pretty picky right now. So there's a real big preference on a well-performing hotel, a well-branded property, and they're going to scrutinize any sort of pro forma. Because the reality is there's owners that are facing, flat RevPAR growth, potentially rising operational costs, fixed costs. So it's still a fairly big challenge to get a deal from a signed term sheet today to closing. And I'd lastly just say that on the rate side, I'd love some more cuts this year. We'll see what happens. I think in general, we're not expecting them to fall too much further this year. And, I think it depends on what happens with inflation and some of the geopolitical issues. So I think the reality is, the buyers are going to be more conservative in their underwriting. Lenders are going to be more conservative when they underwrite. So I think the seller will continue to have the mindset that if they need to sell, they're going to have to chip in a little bit on their side to really bridge that gap and move the market. And we will have a better market this year. I truly believe transactions are going to pick up this year. It's not going to be because of debt. It's going to be because, owners are being a little bit more realistic on pricing.
Okay. So the sellers are. Got it.
Yeah.
sellers have got to make this happen. All right. So a final question for you, Eric. What strategies are helping owners successfully transact in this slower, more selective environment that we're in?
Yeah, it's a function of a couple different things. There's been a lot of inventory that's hit the market in the second half of last year and heading into this year. I think the owners that are getting deals done have some common things. First, I think they're prepared. So they'll put together, solid, clean financial statements. They get some visibility into the PIP. They order the PIP report, and they have a complete due diligence package. I think that in itself will build the confidence from a buyer standpoint that there's not a lot of uncertainty in the deal, and that will then move you to the front of the line as far as them wanting to explore it further. Secondly is the pricing. I mean, that's the most critical piece. Just being realistic on pricing from the jump. So when you launch a deal to the market, be realistic as far as what you're going to guide at. And I think it's at this point a little bit of a waste of time if you go to the market at an elevated price that's based on peak values 2 or 3 years ago. So the ones that are closing are the ones that are realistic from the jump as far as guiding to the market. And then I'd say finally is, story-driven marketing's been pretty key for us recently. So having a deal pitch with a clear business plan for a buyer and a path to the real upside in the deal has helped the deal shine a little bit more and, get a little more interest.
Always easier probably to sell the hotel that's already cash flowing really well without the story of turnaround needed.
Right.
Right.
Yeah.
Exactly.
So thanks for that. Super helpful insights. Matt, do you want to add anything to that?
I think just kind of in addition to what Eric's laid out, I think right now, discipline in execution, that's what's critical in getting a transaction over the finish line. And what I mean by that is owners that are actually getting deals done, they're putting the right team on the field from the outset. And that just means clear, consistent communication between all parts of the team. So title, lender, attorneys, franchise even, and of course, brokerage. If everybody's aligned and communicating early and often, issues get resolved faster. You can avoid some pitfalls, and you don't blow through any deadlines. Which, of course, the goal is to get deals done, and that improves the likelihood to do so.
Okay, great, wonderful. Well, thanks, guys, for joining today. It's been
Thanks, Rod.
Thanks for having me.
Yep, perfect. This is a good segue perfectly into talking with Neil Flavin. Last but not least here, you lead our asset management and hotel management and operational consulting advisory divisions. And we shared earlier how we expect this year to be positive, albeit slow, RevPAR growth trajectory for us. So now operationally in that type of an environment, what should managers and owners be focusing on from your view?
Well, it's a number of different things. We can't always control everything that's below our GOP line. You can control insurance costs to a certain extent because you can change your coverages, but you can't control your taxes and so forth as much. So what do? We take every measure. I break it out into about 4 different categories. The first is protect your GOP at all costs. Now, you cannot save your way to profitability for the long term. You can do that on the short term, but it's going to cost you just as much as many of you know, if you don't stay the course and maintain your facility and maintain your staffing and so forth. So watch your GOP. And how do we do that? Well, through the second bucket is take a look at, especially if you're a franchised hotel, if your hotel is being managed by a third-party operator, look at your shared services costs, look at your IT costs. These are the two areas that nobody ever really knows how to challenge. And these are two extremely costly areas for each and every hotel. So look at those carefully. Work with your franchisee or franchisor, I'm sorry, work with your third-party operator. Get some clear explanations as to exactly what's going into all of these shared services, and then challenge them. What do you absolutely have to have, and what can you live without? And in many cases, the franchisor may say, this is a requirement of the brand. Well, I'd rather lose a point on a QA audit than spend $50,000 on something. And that's a business decision that you might want to make. So challenge these services, and then obviously, challenge, fight back, and see if you can get waivers on as many things as possible. The third bucket that I'm looking at is your labor and your expenses. So in order to protect that GOP, labor and line item expenses are obviously major items to take a look at on a weekly basis, not a month-to-month basis. With the environment as it is today, we can't afford to wait until the profit and loss statement comes out to take a look at how well or how poorly we did from an expense management standpoint over the previous 30 days. As all of us former general managers know, you're only as good as your last 30 days. Well, let's make the last 30 days as positive as they can be. So do you have the right department heads in place? And are they managing, and do you have the right systems in place to manage those expenses, to ensure that your profit or your cost percentages are in line with the rest of the industry? Are they better or worse than last year, and why? Labor's going up. Labor has been going up for the last couple of years. So that is obviously a challenge. But one way to control labor is to retain employees, not turn over employees. So even if you retain at a little bit of a higher cost, your long-term associated costs will be lower due to lack of turnover, lack of training, lack of advertising, lack of everything that you need to do to attract new employees into your property and get them up to speed and be able to take care of your customer accordingly, because you also have to protect your guest satisfaction scores. The fourth bucket that I like to take a look at is outside the box. What are your ROI opportunities? How can you involve your staff, your management teams to look outside the box? Where can we derive additional revenue from? What social activities, local activities, on-property activities can be created in order to drive additional revenue? Can you bring in people for yoga classes, using a local company as an example, but then you work a breakfast into it, things of that nature, or a healthy breakfast. So there's a lot of ways to improve your revenue stream and your profitability by thinking outside the box. And this is what we want to encourage all of the management teams to do, because we cannot continue to do it the way that it's been done. We have to look today for those new opportunities, and we have to continue to work smarter, not harder.
That's great. I always know a hotel's doing that well when I go to check out and my guest room charge for the net room itself is like 30% of my overall night. I'm like, they got me.
That's right. That's right. The old adage is, as operators, we want to make sure that we pick their pockets clean before they leave.
Yes, but
right.
At least, I'm having fun while they're doing it. So
right.
Perfect. Neil, thank you very much. It's been great hearing your insights from that operational view. We are going to move into a short Q&A session we're kind of towards the end of our time, but I'm going to see if you all wouldn't mind staying with me a few more minutes, and we'll we'll answer a few of your questions that have popped up. And there's certainly too many questions to answer on today's session. So we will get to you, I promise. We will communicate with you. And also here at the end, we'll show our presenters' email addresses, so you're able to connect with them. So I do want to just pop up a couple of interesting questions that have come up today. The first question I'm going to punt to Anne. You are, this one is related to tariffs. What has been the impact of tariffs for hotels?
Short answer is not great. In terms of the hotel operation itself, tariffs have affected some costs, and so rising costs and no associated revenue is a problem. The other aspect of it is that tariffs have affected consumers, and so consumer spending and consumer travel has been a little bit suppressed from that. It's hard to, blame it solely and specifically on tariffs, but those have been part of the sort of negative environment. And then last of all, I think tariffs are symbolic of some of the aspects of the current, I don't want to say US behavior because that's tainting us all with the same brush, but I think they're symptomatic of the things that folks perceive as reasons to not interact with the US, not travel to the US. So kind of a soft answer, because I don't think you can, as I said, get a discrete number that is the answer, but I think there are a number of ways in which tariffs are affecting the hotel industry.
Thanks, Anne. This question is from north of the border for you, Carrie. Tariffs are affecting many businesses in Canada, particularly hospitality. What do you see as the impact of these tariffs on Canadian hospitality in 2026?
It's interesting because I think tariffs were part of it was just the mentally consuming aspect of tariffs and the uncertainty that they created. So in February, when tariffs were this reality that we were staring down, nobody knew exactly what to expect because 75% of our trade in Canada goes into the US. So that is massive for us. What kind of shook out as we got closer into the year, we got Mark Carney as Prime Minister. So tariffs, I think, have affected the fact that he's Prime Minister. We realized that most of the trade between Canada and the US, and take out auto and softwood lumber as major industries, most of the trade that goes back and forth between the two countries is under the CUSMA agreement. So we actually are not as impacted by the actual tariffs going on the cost of things coming up here. So we're not seeing inflation because of tariff impacts or retaliatory tariffs going back on things. But CUSMA gets reevaluated this year. We never quite know what the status of our relationship is with the US right now. And so, generally speaking, in the psyche of Canadians, we are not terrified of a grand recession that's coming like we were a year ago. And it's driving Canadians to travel within Canada. So, all in all, the hotel industry is faring fairly well because the domestic market is bolstered by the fact we're just not spending as much money in the US today. But anything that happens in terms of tariffs impacting our economy is going to impact the hotel space. The other thing that we look at related to tariffs is that the majority of the brands are US brands and they're sourcing products in the US. So things that are potentially subject to some retaliatory tariffs are going to impact the cost of hotels, but sort of as it stands today, they're muting growth in the country and creating uncertainty and definitely all consuming in our psyche. But the day-to-day of hotels is still relatively unaffected.
All right, thank you. This one's for you, Eric. What catalysts will assuage the levels of uncertainty and drive more transaction activity?
So I mean, I think we talked about two of them earlier, just with debt, maybe sellers being more realistic. Another would be just operational clarity. You know, if a buyer can underwrite a deal with certainty around like the rep part growth, what the operating costs are going to be, what the property tax is going to be on a reassessment, has insurance gone up? Has it gone down? Has it stayed the same? Things like that, I think will then allow them to be a little bit more clear from an underwriting perspective, and then valuation, and then close deals. So that's the only other thing I would think.
Okay, great. Thank you, Eric. Last question to you, Neil. How can hotels best use AI to impact improved performance?
So a little bit of a tricky question. We're in the business of providing personalized face-to-face service. So my recommendation is use AI where it's appropriate. Use it for report writing, use it for back of the house opportunities, for financial and so forth, that you can easily implement programs, but without losing your face-to-face ability with the guest. The more we get into AI, the more that people are going to be encouraged to remove themselves from personal interaction. And in our industry, you can't let that happen. So use it where it is appropriate. And it's got a lot of great things, and it is improving all the time. But again, where appropriate.
Great. I love that. All right. So I want to thank our presenters today. Thank you for all your insights. Let me see here if I've got, no, I don't. We'll be sure to get the email addresses out to you and share those with you so you're able to correspond with our presenters, and also for all your questions, I'll make sure to get answers out to you. I wanted to thank those that were working behind the scenes to make this all happen, particularly Lisette. You are a genius. I can't imagine all the work that went into bringing together these 2,000 people that signed up to listen to us today. So thank you, Lisette, for your hard work. Dee and Janet and Jeremy and AC for your help making this happen, for the pieces and parts that you played, very important. And again, to my presenters, and for the work you did preparing for today. Much appreciated. Hopefully all of you listening were able to learn something. We'll be sure to share this with you, and we're here to help. So please do connect with us if you have any follow-up questions, either now or in the future. We're not going anywhere. We're here to help. And have a great ALICE conference if you're headed to ALICE next week. That's right around the corner. And thanks again for joining us. I hope you enjoyed the presentation. Have a great day.